Hi there, it's Dean Odell with 7 Gables Real Estate in the Odell Group. It is time for another Tustin Talks. Today is May 19th, and we're going to talk about this market and what's going on. Lots of rumors flying out there, but we got the data. So let's talk about what we're seeing out there in the market and what the data is showing. So let's go to the first chart. So if you saw our last Tustin Talks, you're going to remember I said for the first time in a long time, we're actually seeing inventory climb at a steeper rate, which is great. We really need it. So right now, if you look at this chart, you can see we have 2,452 homes on the market. That's the good news. The bad news is it's still about 3,800 lower than what we need to get back to the pre-levels of when we started wearing a mask, if you know what I mean. So we got to go back to we got to look at those years, 2017, 18, 19. Those were still light years for listings. Even so, that's the closest we have to a normal years in a while. Supply has been muted since 2012. So, things have just really changed here in Orange County and the length of time that people are spending in their homes. And we're going to talk more about that later. But let's go on to the next chart right now. All right, so here's what we're looking at on demand chart. We still have lots of buyers out there willing to purchase at these rates, even though rates are going up. I know you guys are hearing all kinds of things in the news about that. I'm telling you, the rumor mill is just churning, and I'm here to tell you it's still a very strong market, and it looks like it's going to be a seller's market throughout this year. Right now, we have 2,179 homes in escrow over the last 30 days. That's 21% lower than what the 3-year average prior to the big C was, and it's 30% lower than last year. So I know what you're thinking. You're like, well, hey, demand's dropping, and inventory is building. Okay, well, let's look at that, all right? So let's look at the 3-year average versus the current average, and let's just take supply and divide it by demand, okay? So the 3-year average, we had 6,255 homes, and our demand was 3,113. That means we had approximately 2 homes for every buyer that was out there, okay? Right now we have demand of 2,179 for a supply of 2,452. So we have 1.125 homes for every 1 buyer. So see, the supply side of this thing is still in the seller's favor. Interest rates are slowing things down. They're creating new inventory to stay on the market when people overprice. But what we're not seeing is a whole lot of sellers put their homes on the market. We'll talk about that. Next, we're going to go to the expected marketing chart year over year. This better demonstrates what's happening as it relates to whether it's a seller's market, buyer's market, that sort of thing. So as we know, the expected marketing time got down to 20 days. That was crazy. That's just going super fast. Well, now we've gone up to 34 days, all right? So that's about 15 more days to sell a house than it was a month ago. Well, if we look at that 34 days and we look at the chart above here, you're going to see anything under 60 is still a seller's hot market, right? So, if you look at, if we kept on this kind of pace, we wouldn't hit a balanced market for 4 to 6 months. That'd be about the soonest we're going to hit a balanced market. I mean, we're going to keep looking at this thing on a month-to-month basis. If you're adding market time of 15 days every 30 days, then to get to where we need to be, which is 90 to 120 days, it's going to take 4 to 6 months to get there, okay? That's just to get it balanced. To make it a slight buyer's market, you're gonna have to go 4 to 6 months past that, and to make it a deep buyer's market, you're gonna have to go 4 to 6 months beyond that. So there's a lot of assumptions and a lot of things that have to happen for this market to just switch over from a seller's market to a buyer's market overnight. So all this crazy stuff that you're reading in the newspapers and you're seeing on YouTube videos, just forget it. If it's not fact-based, if it's not Orange County-based, if it's not based on supply and demand, it's just garbage. It's just talk, okay? So let's go to the next chart. So we talked about this expected marketing time. This just breaks it down by price range on this chart. What's interesting is if you look at last year versus this year, the $1.5 to $2 million range, that's the one where it's still pretty hot in Orange County, where things haven't changed too much. You can see in other price ranges, interest rates have really taken effect, and we're starting to see some changes. Under 750 is still very, very hot. You can see 4 to 8 million. It actually takes a little less time this year. So the high end is still doing pretty well. The really high end, like the over $8 million, that you can see that's really starting to slow down. It looks like there's about 4 houses for every 1 buyer when you look at that share of housing inventory to current demand. So let's look at this next chart, which is something they put together for just to remind you where the expected marketing time. We talked about it earlier, but this is a chart that shows where the different breakpoints are for a hot seller's market, a slight seller's market, a balanced market, and a slight buyer's market, okay? And then to get into a strong buyer's market, you got to even go above that by another 90 days. So you can see where we are right now compared to other years. We're nowhere near a buyer's market. The next chart I'm going to show you, which is the Tustin chart, this is the week for that. We're going to look just at the 3 zip codes we have here in the Tustin area. We got 92705, 92780, 92782, and we are going to look how this data compares this year versus last year. So starting at what's for sale, you can see that there's really a shortage in the 92705 zip code. They are actually down on inventory, where the other 2 zip codes are up in inventory. You can also see the new listings that came on are also down. Now, why is that in North Tustin? Why is 92705 having a different trend? Well, I could tell you it's price range specific. What we have experienced year after year is that the higher end market, the area that has the most expensive homes, tends to come on the market later than the less expensive homes. And if you think about the domino effect of people buying or selling to buy property somewhat makes sense, right? You got to sell the home below before you can get up there. So anyway, so this is the time of year where we usually will see 92705 really start to increase their listings. We'll see how that goes in the next Tustin Talks. Looking at the average prices, you can see where they are this year versus last year for average active listings. You can see that all of them are much higher than last year. The average sold price, you can also see that's much higher than last year. And you can still see that the average final sales price to list price is still over 100%. So you can see that people are still paying over the list price for properties. And our average days on the market has gone down. Now, this is a lag in data, right? We're looking at what closed in the last 45 days to create this April data, right? So the question is, what's going on now? And that's what we're going to talk about. Okay, so what's going to make a significant change in this market, okay? Because this is not the Great Recession, you guys. This market was built on the backs of pretty solid lending standards, and it's been that way since 2012. Not only that, as we know, prices have gone up, and homeowners have a lot of equity. They have the lowest interest rates they've had on their houses. Homeowners are in a pretty safe position. And I know that everybody has heard all this talk about forbearances and foreclosures and all this kind of stuff. Forbearances, over 90% of the forbearances from the crisis that we went through has been worked out, okay? So there's only maybe 10% of the homes that were actually in forbearance that may come to the market, and we're still 50% low on our inventory. I mean, we could use that inventory, okay? So that's not going to crush the market. So what's going to crush the market? Well, interest rates are going up, but guess what? There's still, like, on average, 5 buyers for every house. So that's not going to crush the market. Even if half of them go away, we'd be okay, right? So the only thing that's going to crush this market is a glut of inventory over demand. And how is that going to happen? Well, let's talk about that. Orange County, when I came into the business 30 years ago, the average turnover time, people stayed in their houses 7 years. Right now, over 20. Okay, so you have people staying in their houses almost 3 times as long. And people don't have the incentive to move unless you're changing locations or you really have a need. people aren't just moving up to move up anymore, right? So they're locked into lower interest rates. They're not motivated to put their house on the market and pay a higher interest rate. They've got lower taxes. So what is going to cause all this inventory to come on the market like it did last time, when we don't have bad lending, we don't have any of the elements practically that we had before? Well, I'll tell you what's going to make it happen. It's going to be when people lose their jobs. That's it. And when's that going to happen? I don't know. That's your assessment of the economy in general, right? Right now, yeah, things are a little shaky. The stock market's going down. People don't feel as confident maybe buying and everything. But I'm telling you, we're out there on a daily basis, boots on the ground. I'm always going to tell you when things are changing, and they have changed. They've let up. It's not as crazy as it was. But we've gone from going 200 miles an hour down to 120, okay? So it's not, crisis time here. As much as we all would love for that to happen on the buyer side, it's not going to happen. The sellers are still in control of this market, and they're probably going to be in control of this market throughout the year. If you look at the home appreciation forecast, the top 105 economists that do real estate forecasting, optimistic, 46% appreciation through 2026, okay? Middle of ground, people that aren't optimists, 26%. The most pessimistic, 10%. There is nothing indicating that prices are going to turn around and start cratering backwards, okay? I know it doesn't seem possible, and I know we're going to have a recession, but guess what? Housing prices don't always go down in a recession. The only recessions that housing prices have gone down in was the savings and loans crisis and the Great Recession. Those are the two, at least recently, since the 1970s, all right? So I'm not the guy that wants to say prices are going to go up forever, but maybe they're just going to get in check with normal appreciation at, 3% a year. Maybe they're going to flatline. But for them to turn around and go down 20%, we're not seeing it yet. And as soon as I can see it, as soon as it's in the data, you guys are going to be the first to know. So in the meantime, if you find a house out there you like, buy it. Sellers, if you're ready to move, still a great time. Not quite as crazy as it was, but still excellent. So give us a call. We'll get that house ready for you to sell. And buyers, if you need some help, give us a call. We're getting our buyer offers through. Hey, thanks again for tuning in to Tustin Talks. And please, if you like this or want to comment, please do so below. And we'd love to hear from you. And we'd love to get this information out to the most people possible. So thank you. Bye-bye.